Thank you for being here. I'm going to apologize for my voice. I've done 6 speeches with a voice less than this in the past. I think you know that I love doing what I do, and I think you can help me by pretending I'm really enthusiastic tonight, okay? We'll get the information done. Yeah, go ahead and cough. It might help me too. I'm so happy to be here. It's fun. And it's fun listening to Lisa talk. It was fun to see Koch Industries continue to invest in Wichita. I've had this long-standing daydream about Koch Industries that someday they would buy the New York Times and the Los Angeles Times and then close them. Just a minute. Okay. Let's get started. This could work out. I think it might. We'll see. If it doesn't, just bear with me again. I apologize. I'm allergic to cedar, and this is cedar season in College Station. And I did 6 speeches like this last year, so it'll work. Trust me. About 6 months ago, somebody came up to me and said, Mark, you don't put pictures in your speeches anymore. I'd like to see pictures again. And so I thought, okay, pictures it is. And I tried to decide what picture would be appropriate for the first of 2015. And this is the picture I came up with. I'm really proud of America. Our job growth isn't as fast as it should be. If you've been to any of these speeches in the last 7 years, you know exactly why I think that is, and I'm not going to belabor it again today. But the fact is our economy is growing about 2 to 3% a year. And based on the wartime conditions that businessmen and women are working on in this country, I'm very proud of them for that standpoint. I'm bullish about the outlook for 2015. I turned bullish in 2011. If you were here in 7, 8, 9, and 10, thank you for coming. Give you a Purple Heart. I apologize for that. It's been a lot more fun to be bullish than it has been the other side of things. But here's what our business owners are fighting every day. We've got a hot war going on in Iraq, Syria, and Afghanistan. We got people that want to kill us every day. We're spending money over there that could be invested in America, in infrastructure and other things. But unfortunately, we're having to spend the money to protect ourselves from these people. In addition to that, every day that goes by, Russia, North Korea, China are trying to steal all of our information, all of our business information, all of our professional licensed technology, all of our personal and health information, and our businesses are spending billions of dollars every year, not investing, but spending billions of dollars to protect them from this kind of stuff. In addition to that, we have a currency war going on with China, Japan, and Korea. Boy, if I get this closer, I'm going to sound really powerful. I'll do that. Nobody will use this mic after I do, I promise you. If this was back in October, I would have fun with that and say, I just flew in from West Africa and I'm feeling feverish. I tried that in San Antonio and nobody shook my hand, I promise you, not one. Okay, Japan is trying to destroy their currency, and now Europe's trying to do the same thing, and so's China. Do you know why they do this? Because they can't compete with us. Because our technology's too good, our workers are too good, our freedom is too good, our protection of private property rights is too good. They can't compete with us without doing this to us, and even then we're still beating them. And then we got kind of surprised along about Halloween with this carbon war, I call it, with OPEC. OPEC's decided to declare war on the American oil industry. They're trying to run us out of business. And I'm going to talk about that because it doesn't matter where you go. If I'm in Las Vegas or Atlanta or Wichita or Houston, everybody wants to talk about oil. So I'll talk about that. And then finally, we have this regulatory war going on with Dodd-Frank. I'm sure we have lenders in this room. This is a nightmare for lenders across this country. The pendulum swung from over here of, if you have no credit, no money, no job, we'll loan you 107% to buy a home. That was a stupid idea. And now we're over here to this over-regulated environment with the Consumer Finance Protection Bureau. I call it the Pollitt Bureau, because these people are making it hard for people to get loans in this country, and they know it. And the Federal Reserve knows it, and Fannie Mae and Freddie Mac know it, and the SEC knows it. Now, anytime I got any Aggies in the room, I have to explain that there's more than one SEC, okay? I'm talking about the Securities and Exchange Commission, okay? All of these people, the Federal Reserve, the Fannie and Freddie, and the Securities and Exchange Commission know that our economy would be a lot stronger if these regulatory monsters would ease off and stop punishing our banks and other people that originate mortgage loans. The sooner we get that done, the better, and it's totally political. You can't overthrow healthcare. You can't overthrow Dodd-Frank. But I bet you could rewrite 3 sentences that would take some of this punishment off of the banks for making mortgage loans, so that people here in Wichita, Kansas, that are working for a living, maybe don't have perfect credit, but they could buy a house like the good old days, like they used to. So with that said, this is why I'm proud that we're able to grow at 2 or 3% with this 5-front war that's going on with business owners. And at this stage of the economic expansion, I start bringing this slide out again. I haven't used this for like 5 years. People will ask me, how long can this expansion go? So I wanted to document that for you. What you can see here is since 1950, we've had 11 economic expansions. That's what we do in America. We have an expansion, then we have a recession, and another expansion and another recession. It's just purely coincidental, but the average expansion in the last 64 years is 61 months. That's exactly how many months this expansion is as we sit here tonight. If you look at the ones that I circled in red, there's several expansions that have lasted a lot longer than that, 106 months, 92 months, and 120 months. Now, I remember distinctly giving speeches in 2000 and early 2001 because we were up to 10 years. The average was about 6, and we're at 10 years. And I remember saying, folks, I can tell you exactly there's one person in America that's single-handedly responsible for the fact that this expansion has lasted 4 years longer than average. And that one person, who might you visualize that in about 1999? That person in my mind was Monica Lewinsky, okay? Because about that time, the expansion was getting pretty long, and all of a sudden, all of the focus in Washington, D.C., the president totally focused on the blue dress. All of Congress, the House and the Senate, focused on nothing but the blue dress, and all of the media couldn't write anything except about the blue dress. And you know what happened? Congress didn't do anything to damage businesses, and they just kept growing, okay? We've got room to run here. We've got room to run. I'm still bullish. We're nowhere near the end of this run in the economic expansion. In my mind, you will want to see the facts. The other part of that story is we've had 10 recessions in the last 64 years. They only last 11 months on average. They're pretty short. Like I said, we're nowhere near that point as we sit here tonight in Wichita. Because of that, that's why I'm bullish. Continued for 2015. I'm particularly bullish about commercial real estate in general. I'll explain why in a minute. Here's why I'm kind of bullish about the job outlook for America, and that is that consumer confidence just continues to get better. People are getting jobs again. Wages are starting to go up. You might have heard today that Walmart's going to give 500,000 people in America a pretty substantial pay raise. This is going to be good for America. We need more of that. I might say this right now, that while I think interest rates are likely to stay low, and I've been telling you for the last 5 years since 2008, interest rates are going to stay low. Don't listen to what those people are saying about the Fed will taper and interest rates will go up. But I'll say this. One of the reasons I've said that interest rates are likely to stay low is because inflation will stay low, is because wages aren't going anywhere. It feels like in 2015 wages are going to start going somewhere, and that's good for a working man and woman to get a pay raise. That's going to be great for a whole bunch of retailers in this country that have been waiting for that. If you're a retail firm that sells stuff to rich people that own houses, cars, commercial real estate, stocks and bonds, you've had a good market for the last 2 or 3 years. But if you're a retailer selling to a single mom that works for the county or the school district that hasn't had a pay bump more than 1 or 2% for the last 5 or 6 years, that woman hasn't been doing so well, and she's been struggling to buy stuff. It's about time she starts to get a pay raise. So the trade-off will be, and watch what happens with the longshoremen. I was just in Houston a couple of days ago, and we were talking about the longshoremen strike out in the Los Angeles port area. Those guys and gals are going to go on strike to see what kind of pay raise they get. Watch that, because it'll be interesting to see how much of a pay bump they get, because what happens is when one trade group, when one union gets a pay bump of 2, 3, 4%, then all the other unions in America will try to copy the same thing. So if we see the longshoremen getting a pay bump of like 3, 4, 5%, I would say the likelihood of interest rates going up goes up considerably. We'll watch it and see. Internet sales are exploding. This is causing big changes not only in retail, it's putting a lot of pressure on small firms that want to sell products in Wichita and all over the rest of the country, but it's also creating demand for a more industrial space, because places like Amazon and other big internet retailers are wanting to bring the product closer to you. They want to be able to deliver product to you within a day or 2 at the most, and that means they can't do that if they got a warehouse in Des Moines. They've got to have warehouse space closer to the customer. So this change that's going on with internet retailing is creating a whole change in the landscape of industrial warehouse development, and creating more industrial warehouse development in smaller communities like Wichita. Wichita is a big community, trust me. I just come out of a couple that are 4 million, so I'm not casting aspersions on you for not being 4 million. Other good news, car sales are almost at record highs. The Federal Reserve is looking at this going, this is what we want. We want a budding economy. Car sales are near record highs. Here's something you got to know. There's always a little nuance to things. Something that's good got a little bad to go with it. Something that's bad got a lot of good to go with it. The interesting news about car sales is that car dealers and manufacturers have figured out a new financial engineering trick that they're using in spades again, and it's called subprime auto lending. You ever heard of subprime loans? Yeah. Something like 30% of all these car sales are now subprime loans. Another area that's picking up in the subprime market is subprime credit card lending too. So we're kind of rehashing where we were in 2005 and 2006, where we get a lot of retail sales and we get a lot of car sales with subprime lending. You know the one area that you can't get subprime credit for? That'd be to buy a home. I made a comment in Des Moines, Iowa. Hey, for you bankers in the room, we're cousins now. Because I personally got criticized by the Office of the Comptroller of the Currency. That guy called me. That's their regulator, the OCC. If you get criticized by the OCC, that's dangerous. If you're a banker, for me, I could care less. Okay? He called me and asked me to shut up, basically, and I basically told him, I'm not a bank, and I don't care what you got to say, pal. I made this comment that the OCC is single-handedly responsible for the fact that our economy isn't picking up as fast as it could because they're stifling lending to home builders to build new homes. And they're stifling lending to subdivision developers that need to put lots on the ground. And what's happening is we don't have enough lots on the ground, we don't have enough houses being built, and that's why partially why our economy is growing slow, and that's why the Federal Reserve, Fannie, Freddie, and the SEC are all over this, saying we got to do something because we got to have more homes built in this country. This number, I keep showing this every year, this is the most bullish slide of all. It doesn't matter who's in the House or the Senate or who the president is or whether the Fed raises rates. This is your ability to buy stuff. This is a percent of your income that goes to pay debt service on loans. It's never been lower. Another way to say that is, we sat here tonight in February in Wichita, Americans have never had a higher percentage of their income available to buy stuff. And you combine that with a globally known fact that Americans do not tolerate deferred gratification. And that's all you need to know about being bullish in America. There's one thing that nobody can outdo us on. I don't care who it is. There's nobody on this planet that can spend money better than an American. Okay? And that's 65% of our U.S. economy. Our net worth has skyrocketed to $81 billion. Forget about the Federal Reserve. Your net worth, the American people, is 81. I said billion, I was wrong. Your net worth is $81 trillion. And the Federal Reserve, I just checked again the other day just for fun. You know what their net worth is at Washington level? $50 billion. That's like pocket change compared to what you got, okay? That's why I'm bullish. I'm bullish about the American people. We are thriving, surviving, and growing in spite of our government. The business sector, corporate profits have kind of flattened out. You got to be a little careful about this because we live in a capitalistic system. There's some of you in this room that are kind of close to 30, and some of your colleagues think socialism is a better alternative than capitalism. I'd like you to give them my home phone number so they can call me and I can tell them how stupid they are. If you're not old enough to remember what it was like to live in the Soviet Union and have the government picking out the stuff you buy and telling you what job you can have and what kind of bridge you can get. You ladies out there, how'd you like to go to the gum store? Try this on if you like socialism. Go to the gum store, and I'm the old socialist boss, and I'm the guy that figures out, I'm the guy that tells, we're going to do this and this and this. And you know what my favorite product to make is? Tractor tires. Because my brother makes them all, okay? And what's going to happen is you go to the department store and you're going to see in there a whole bunch of aisles full of tractor tires. And you go, where's the perfume at? Show me where the fragrances are. And I go, they're right over there. It's the essence of tractor tire. That's what socialism is all about. If you like that, take another class in economics, please. We can't afford that again. We've been through that before. Small business hiring just continues to expand. I don't think people are afraid of Obama health care anymore. I think it's starting to become clear it's not the end of time. And so, as you can see here, profits are up, but they're kind of going flatter, but hiring plans continue to expand. And that said, this has finally picked up. This is not just saying, are you, small business owner, going to hire people, but are you willing to expand your business? And that's been flat for like 5 years, and that has finally started to pick up as well. Corporate hiring gets even stronger, 43%. These are large companies. The other I just mentioned are small firms. 43% of the big companies say they're going to hire, and only 14% say they're going to lay off. So the foundation is there. Profits are up, hiring patterns are in place, jobs are being created. That's why I'm bullish. Manufacturing is picking up as well, and that's good. proprietors' income is strong. Business owners across this country, their income has skyrocketed in the last couple of years. This is why people are willing to hire. And then here's another issue you'll never hear on any TV station because it's positive news, and they don't want to broadcast positive news because we don't want to hear about it. But hear this: 5 million jobs open today in America in every discipline. We got a job, we have a labor shortage in this country. We've been talking about unemployment being so high and the labor force participation rate going down. Well, the fact of the matter is we've got 5 million jobs that need somebody to work. And so with that said, here's what part of the issue I need to address now. It's called an exogenous shock. Maybe some of you, it's been a year since you've been in your economics class, but most of you will remember the two key words, supply and demand. If you can even spell supply and demand, you got a B- in most economics classes right off the bat, okay? And if you can spell exogenous shock, you're up to A-. And if you know what an exogenous shock is, you know more than most of the professors, okay? Here's an example, because our economy's dealing with an exogenous shock right now. Let me illustrate one. I still really like to play golf even when I'm shooting 113. And visualize this. I finally get out to play golf with some industrial realtors down in Dallas, and it's 80 degrees, and I'm out there swinging, getting loosened up, thinking, gosh, it's so nice to be outdoors and play a little golf. So I get my 1-iron out. It's a little narrow, so I'm going to get my 1-iron out, hit it, and I do, and I catch it right on the screws, and it's down there about 210, and I'm holding my follow-through just to savor watching that ball down there, and I get struck by lightning and die. That's called an exogenous shock. You can't plan for it. It was completely unexpected, and the payoff is massive, okay? We got one of those around October. It was these guys. These guys put a little exogenous shock on all of us by deciding to drop the price of oil until they run the American oil companies out of business, and in the process probably run Russia in the ground and Venezuela, maybe Iran in the ground too. Make no mistake about this is economic warfare. This is just as painful as shooting bullets. This kills businesses, it kills jobs just as much as you kill people with weapons. And so with that said, let's look at it. Nobody saw this coming. As late as October 3rd, oil was $90, and they decided to drop the oil price. And I love it. See, I'm going to illustrate for you in 2 slides here. I'm going to illustrate to you what I think is going on here. This is going to be the story to watch for 2015 because the rest of the market is kind of on its way up. This is where we don't know. Let me illustrate for you what I think is really going on. We have about 2 or 3% too much oil being produced, 2 or 3%. If you visualize, I got a table right here of 8 people. There's the Saudi oil minister, there's the Iranian oil minister, Russian, Libyan, Angolan, Nigerian, American. They're all sitting there at a table and they're going, if we just cut production by 3%, I think we're good. And they look around the table and go, but I know you won't do it. I know you'll cheat. So what are we going to do about it? Well, let's try this little game and see how it works. Let's all put a plastic bag over our head, wrap it with duct tape, and see who dies first. That's what's going on. And Vladimir Putin is over there. His face is pretty red. He's sweating a lot, okay? Venezuela, that guy's sweating, or that lady, she's sweating a lot too, okay? The sad part of it is the American oil business is going to die first because they're not a family-owned business. when the Shah, we don't have a Shah anymore, or whatever they call it, whoever runs that country now in Iran, whenever that guy, that's his oil company, okay? He's not going to foreclose on his oil company. The Saudi royal family, they're not going to foreclose on the Saudi oil business either. I don't think Vladimir Putin is going to put his oil industry into bankruptcy either. But these oil and gas people in America, you know who they're financed by? They're financed by private equity and junk bond holders who can't wait for them to miss their payments so they can foreclose on them and take over their oil prospects. So that's what we're going to see this year. We're going to see, over time, poorly funded oil companies that paid too much for the land, financed their business improperly. They're going to go out of business. This is going to be a short-term situation, but it could last a couple of years. People think that production's going to drop pretty quickly and the price of oil will go up by the end of the year. I don't think that's going to happen. The reason for that is that all these oil companies, a lot of them have hedged their oil production. And what that means is, yes, the price of oil today is $49. But they sold their oil 6 or 8 months ago for $90. So they can produce everything that they can punch out of the ground for the next 8 or 9 months and get $90 a barrel for it. So they're going to keep producing it and keep producing it and keep producing it. And Russia's got to keep producing it, because if they don't, they lose their government. You see, forget about this issue about, you might hear them say, well, goodness sakes, the Saudis, their marginal cost of production is what? A nickel? I mean, how much does it cost to take a thimble and get the oil up and put it into the truck? $5. But that's not the issue, gang. Here's the issue. It's not the marginal cost of producing oil. It's the marginal cost of keeping your government from being overthrown. The Iranians need something like $140 a barrel to pay for their social contract they have with their citizens. The Saudis need something like $60 to $70 a barrel to honor their social contract with their citizens. Vladimir Putin, I don't know how much he needs, but you see, when you're a dictator, or I'm the head of the Saudi government, and my family, we got a lot of money, and you don't. Well, you don't like me all that much unless I give you something, right? And for me to give you something costs a lot of money. And that might cost me $60 a barrel in oil. And if I don't give you stuff, you don't like me anymore. And all of a sudden, I don't have a government anymore. That's what's at issue this year, too. Our American companies will get foreclosed on, the poorly run ones will. But these other countries, they don't have a foreclosure issue. They got a government overthrow issue. The longer they keep rates, oil prices low, the closer they run into losing their government. And look at this dialogue here. I documented this out of the Wall Street Journal. You start thinking about the people with the bags over their head and with their customers out there saying, you promised me stuff and you better give it to me. Look what happens here. The Saudis decide to cut oil prices on October 3rd, and it dropped below 90. And 10 days later, the Kuwaiti oil minister says, we think there's a natural floor about 76 to 77. See, that's where he wanted to go, because they thought below $80 it puts Americans out of business, and at $76 it puts Americans out of business and still allows them to give you the subsidies you need. And then the price dropped to $81, and then the Saudi prince Al-Walid comes out and says Saudi Arabia needs $80 to $90. Why do you think they need $80 to $90? Do you think they need another ski lift inside of a big shopping mall? Okay, they don't need anything. They need $80 to $90 to preserve their government. Now, Goldman Sachs on October 28th, they're still thinking oil is $90. They come out on that day and say, oh, well, maybe we think it's going to be 75. And that same day, Citigroup and Deutsche Bank all cut theirs too. And then the Saudis cut price again, and it goes to $77. Now watch this. On November 7th, an unnamed OPEC official says at $70 there will be panic in OPEC. If it costs you 5 cents to get it out of the ground, why are you going to panic when oil is 70 bucks? There was also the same comment, same article, where prices to fall below 70, there will be action from OPEC. I'm guessing that unnamed Saudi source, OPEC source, you probably won't hear from him again. I'm guessing. Okay? So OPEC says, we don't think it'll fall below 75. You see what they're doing? We just want to get to 75, and that's all. And it got away from them, and now it's 49. December 4th, the Saudis say, we think oil could stabilize at 60 bucks, a price they believe they could withstand. Look at the wording on that. You see how important the little words are once you see the story? What does that mean? That around 60 bucks, it's a price they believe they could withstand. Number one, that means they don't know whether they can withstand it or not. And what are they going to withstand? You see what I'm saying? At 60 bucks, I'm saying, I think at 60 bucks, we can preserve our government. At 60 bucks, I know you Americans are going to go out of business, but I might go out of business too. So this is where we're at as we sit here tonight. That's going to be the story of 2015, is to watch poorly financed oil companies in America that overpaid for everything, watch them go out of business and sell their assets to better run companies who will turn around and produce oil in the future. And at the same time, we'll watch Iran, Saudi Arabia, Venezuela, and Russia and see how long they can hold on to their governments with rates this low, oil prices this low. The other thing you got to know, you might remember in 2007 or 8, is probably 7, when I said, look, I know some of you are wanting to buy gold and buying ammunition. I understand that. And at the time I said, you know, if you're even thinking about buying gold, I would recommend you take cocaine instead, because at least you'll feel good before it kills you. You remember that comment? Well, those same people, the reason I said don't do that is because gold is a speculative commodity. You don't invest in gold. It goes up. People hedge risk with gold, or they speculate in gold. Those same people that drove gold to 1,900 bucks and then drove it down to $1,100. Those are the same people that trade in the oil markets. And I want to show you this because the last time oil got low was December 28th of 08. It got to 32 bucks, and a year later it was back up to 79 bucks. So if anybody tells you they think they know what the price of oil is going to be 6 months from now or a year from now, I'm guessing that might be Brian Williams in person. The inflation outlook continues to be low. A strong dollar and declining oil prices means stated inflation rates going to be virtually nothing. And keep in mind, watch that. That will be an early signal going forward, not this year, but the next couple of years. Watch those rate hikes. Watch those wage settlements at organized labor contracts. And if those get above 2 into the 3s and 4s, that means our economy is going to get even stronger, and that means inflation and interest rates are likely to start to go up. I want them to go up. I want interest rates to go up. I want our economy to be strong enough that it warrants higher interest rates. That's what we want, and we hope we can get it. My voice sounds horrible. I'm so thankful that you're just still here. Honestly, thank you. It's hard to listen to, I know. Okay, so with that said, interest rates are remarkably low. A year and a half ago, smart people were telling you that the Federal Reserve is going to stop buying long-term bonds, and the 10-year Treasury is going to go to 3%, and commercial real estate values are going to plummet, and it's going to be hard to sell houses because mortgages will be 5%. That was totally bad information at the time. The 10-year Treasury didn't go up to 3%. It went down to 1.6, and as we said here tonight, it's up above 2. But this chart that I put together, this little table, it's just February 12th. The 10-year Treasury is 199. Now, here's the point I'm going to make, and I don't sell commercial real estate. There's people in this room that do, but I'm not here to sell you commercial real estate. I'm here to tell you why I still have 84% of my retirement account in TIAA-CREF's commercial real estate account, because the alternatives are not available. I have a lot of people come up to me, if you don't own real estate, stay with me a minute, because I'm going to talk about bonds and stocks in a minute too. But if you own commercial real estate, you might have had this experience where somebody's come up to you and said, I'll offer you a ridiculous price for your whole portfolio of apartments. And you'll come to me and go, well, we don't know what to do. Our family doesn't know what to do. We're getting these ridiculous offers to sell our industrial buildings, our office buildings, our apartments, retail, whatever it is, and we don't know what to do. What do you think? And I'll say to them, what would you do with your money if you sold it? And they'll look at me and go, that's what I'm asking you. And I'll go to you and say, if you don't know the answer to that, then it's too early to sell your real estate. Here's the thing, if you get out of real estate, you got to go somewhere. Where do you go? Well, you go into bonds, you go into stocks, and that's about it. And so with that said, our interest rates are low, but I don't think they're going to go up much, because look what's happening around the world. The Italian bond rate is less than ours. The Spanish bond rate is less than ours. The United Kingdom's bond rate is less than ours. And then you get into the French. You think a 2% interest rate on our 10-year is low and it's going to go up? Well, not quite. The 10-year, if you want to invest in a 10-year bond in France right now, you're going to get 0.64%. That's less, almost a 0.5% interest every year for 10 years. The German is 32. The Japanese is 38. You could take your money to Japan and get 38 basis points a year. That's not even 1%. And if you really don't like those countries, you can go to Switzerland and get a 10-year bond with a negative yield. How about that, a 10-year Swissy with a -3 basis points? Now, I was force-fed finance at the University of Texas in their PhD program for 5.5 years. I read every textbook in the library. I taught it for a long time as well. And I can tell you there's not one sentence, not one paragraph in any of those finance textbooks that tell you how to figure the present value of a bond with a negative interest rate. All right, for all of you with a financial calculator out there, what do you think happens when you punch in a -33 bips on your little I button? You know what happens? It blows up on you. Goes, you fail, throw this calculator away. You're not qualified to be in any business. This is unheard of, folks. Our country, the reason I'm still really bullish about commercial real estate, even though it's, here's a nutshell. As you said here tonight, if you own a bunch of commercial real estate and you're going, man, I don't know, maybe I ought to sell. Or maybe you're thinking, I don't know if I'm going to buy any more commercial real estate in Wichita or anywhere else in America because the prices are high. Here's what your options are. You can get that 10-year Swissy for a minus, or you can go into stocks, or you can go into commercial real estate. I'm not interested in these bonds. So as we said here tonight, bond prices are at record highs, the stock market's at record highs, margin debt in the stock market's at record highs, and commercial real estate values are record highs. So which one do you want to own? Sell your commercial real estate and waltz right into the Dow at 18,000 right now with margin debt at record highs. It's probably not going to work out so good for you. You see, America has a lot of problems. Our debt is up. It's 18 trillion. It's 19 trillion, whatever the number is. But you know what? The fact of the matter is, despite our problems, America is still the prettiest pig in the trough globally. Money is flowing into this country, and a bunch of it's going into commercial real estate. I just talked to a guy in Houston about 5 days ago that sold an entire city block to a Russian family, a city block in Houston. These people could care less about the price. They could care less about the yield. They're interested in one thing and one thing alone, and that's getting their money out of their godforsaken country and getting it into a place like America. Here's the facts on the margin debt. I showed you this last year, so I won't belabor it. But as we said here tonight, margin debt, not only is the stock market at a record high, but margin debt is at a record high too. And when you get this kind of environment, when they start to go down, they go down hard together. I'm not saying the market will go down. I'm just saying that over history, it's not a good time to buy stock when margin debt is at a record high. And so I just want to document for you some of this commercial real estate stuff, and I'm just about done. I got 2 slides left. An old economist said that, told me once that every economist should use the words "in conclusion" in their speech to give their audience hope. So I'm there, okay? Thank you for staying, I appreciate it. But just look at what's happening. Not only stocks at record highs, bonds at record highs. Foreigners invested $10.6 billion in down months of 2014. That dollar amount of investment was up 69%. Office buildings in Washington, D.C. are selling for $611 a square foot. One office building in D.C. recently sold for $948 a square foot. Chinese investors paid the highest price ever for a freestanding building when they paid $1.95 billion for the Waldorf Astoria in New York. And not only that, but China and Taiwan have loosened their regulations so their pension funds and insurance companies can come over and buy real estate directly. That's who you're competing with. If you get into the big markets of this is why Wichita still looks really good. And not just Wichita, but every other what we'll refer to as second and third tier cities in terms of commercial real estate investment. Don't take that personally. It means nothing. It's an investment term. First tier cities is to Boston, Washington, D.C., New York, and San Francisco, and maybe Los Angeles. Okay, outside of that, those places are where all the foreign investments go in largely, and those prices are gone through the roof, and that's forcing people to go out and start looking all over America saying, I don't want this low yield that I'm getting here. I don't want to compete with somebody that doesn't care about return. And you see those foreign investors, for the most part, they don't know Wichita, Kansas. They don't know Tulsa. They don't know Des Moines. They don't know Colorado Springs. And those people aren't fishing in this pond. And when they showed the cap rates being 6 to 8%, or was it even higher than that? What was your cap rate number? Do you remember? Was it 8 to 10 or 6 to 8? 8 to 12? Yeah, looking at 8 to 12, it's like, oh my gosh. I had a lady in Los Angeles come up to me and say, you're talking about foreign investment here in town? I just sold an apartment building in Beverly Hills, not with an 8 to 12% yield, with a 2.9% yield. So the yields, then this one right here, the next to last one, key. Low yields in gateway cities, that's what they call them, or primary tier cities. Low yields are driving up sales volume in places like Tulsa, Colorado Springs, Pittsburgh, Birmingham, and we could just tonight add Wichita, Kansas into the mix. So with that said, the real estate investment trust, look what's happened here. They had $176 billion in investments in 2008. That has skyrocketed to $846 billion. People can't own enough real estate. One other piece. California Pension Fund, one of the biggest pension funds in America, just decided they're going to bump their investment exposure to real estate from about 6% to 12%. And when they do it, everybody else in America will be doing exactly the same thing. So you've seen a lot of money flow into commercial real estate up to date. There's even more money coming from foreign investors, real estate investment trusts, and pension funds. And so this is just kind of evidence. This is where it was 81% of my retirement account. It's now up to 84% because it's gone up so much faster than the stock market. But as you can see here, when this peaked out in 08, I decided I better get out and sell. And then I got back in when they marked the portfolio down, and I was thinking, I'll sell when it gets back to the same number. When it gets back to the same peak of 07, I'm going to sell and get out. Well, you can see it's now way above that peak of 07, and I'm not even thinking about getting out right now because I'm watching this huge pipeline, this huge tidal wave of capital coming into America, wanting to buy real estate even more. So with that said, I just want to thank you for your kind attention, for inviting me to be here. Thanks for coming tonight. Nestor, thank you for inviting me again. It's a pleasure to work with you. Have a great evening. It's a wonderful time to live in Wichita, Kansas.